Welcome back, my friends. This week, Softbank posted record $32 billion loss at its Vision Fund tech investment arm. Softbank recorded a record loss for its Vision Fund as a recent rally in tech stocks has done little to help another difficult year for its flagship investment unit. The Japanese giant's Vision Fund segment posted a 4.3 trillion Japanese yen, $32 billion loss for its fiscal year ending March 31st versus a 2.55 trillion yen loss in the same period a year before. Around a year ago, Sun said Softbank would go into defense mode amid the headwinds and be more disciplined with its investments. For those of you not familiar, Softbank Group Corp. is a Japanese multinational conglomerate that primarily operates in the technology and telecommunications sectors. It was founded in 1981 by Masayoshi Son and has since grown into one of the world's largest technology investors. Softbank has a diverse portfolio of businesses, including telecommunications, internet services, robotics, clean energy, finance, and many more. Softbank is also known for its massive investments in tech startups, particularly through its Vision Fund, which is the world's largest technology-focused venture capital fund. The company has made significant investments in companies such as Alibaba, Uber, WeWork, and Arm Holdings, among others. Softbank also owns wireless carrier Sprint in the United States and has a controlling stake in the Japanese telecommunications giant Softbank Corp. What does this mean for the future of the economy? And what does it mean for the future of the United States? But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. The Softbank Vision Fund is a $100 billion technology-focused venture capital fund launched by Softbank Group Corp. in 2017. It is one of the largest and most influential venture capital funds in the world. The fund is focused on investing in promising tech startups across a wide range of sectors, including artificial intelligence, robotics, transportation, healthcare, and more. It seeks to identify and support companies that are disrupting traditional industries and changing the world through technological innovation. The fund has been instrumental in supporting the growth of companies such as Arm Holdings, Nvidia, and Alibaba. Softbank's founder and CEO, Masayoshi Son, has described the Vision Fund as a way to invest in the future and create the world's next Alibaba or Amazon. The fund is managed by a team of experienced investors and is known for its large, strategic investments, as well as its willingness to take risks on startups with ambitious goals and innovative technologies. Softbank recorded a record loss for its Vision Fund as a recent rally in tech stocks has done little to help another difficult year for its flagship investment unit. The Japanese giant's Vision Fund segment posted a 4.3 trillion Japanese yen, $32 billion loss for its fiscal year ending March 31st versus a 2.55 trillion yen loss in the same period a year before. Softbank posted an overall loss on investments at its Vision Funds of 5.28 trillion Japanese yen versus 3.43 trillion yen a year before. Despite a rally this year in tech stocks, they are broadly still lower than a year ago. The tech-heavy Nasdaq 100 index declined about 11% during Softbank's fiscal year. Overall, Softbank posted a net loss of 970.14 billion yen for the fiscal year, narrower than the 1.7 trillion loss in the same period a year before. Despite gains from exiting investments in high-profile companies like ride-hailing firm Uber, Softbank said that it logged losses in areas including the share prices of Chinese artificial intelligence firm SenseTime and Indonesian ride-hailing and e-commerce company GoTo. Over the past year, Softbank has been exiting some of its highest-profile investments to raise cash. It narrowed its overall losses through sales of shares in T-Mobile and Alibaba. It continues to offload some of its shares in the latter company via a derivative called a forward contract, after Sun made his fortune with an early investment in Alibaba more than 2 decades ago. In August, it said it had sold its remaining stake in US ride-hailing giant Uber. The companies that SoftBank has invested in are well capitalized, according to the Japanese giant's chief financial officer Yoshimitsu Goto. He said SoftBank has a number of companies ready to go public, which are valued at a combined $37 billion. Amid mounting losses, Sun's key ally and top SoftBank executive Rajiv Misra stepped back from some of his roles at the company. Misra was instrumental in the early days of the Vision Fund, which was launched in 2017. Around a year ago, Sun said SoftBank would go into defense mode amid the headwinds and become more disciplined with its investments. That tactic appeared to be working in SoftBank's fiscal fourth quarter from January to March, helped by the rally in tech stocks. SoftBank's Vision funds recorded investment losses 236.8 billion yen in the period, versus 730.3 billion yen in the quarter before. SoftBank said it made $3.14 billion in new or follow-on investments in its fiscal year, down from $44.26 billion in the same period of a year prior. During a press conference on Thursday, Goto said that it has been an unstable year marked by geopolitical risks and financial system instability, citing the collapse of Silicon Valley Bank and issues at Credit Suisse. In the first quarter, we may be able to see some signs of improvement. However, we are not expecting a fundamental resolution for those issues, Goto said. He nevertheless said that artificial intelligence technology is making dramatic progress, with the company weighing up whether to stay in defense mode. With those situations, should we just keep in defense or should we keep a balance with offense? Goto asked. Now investors are looking toward the initial public offering of British semiconductor firm ARM, which is owned by SoftBank, as a way to shore up the Japanese firm's balance sheet and perhaps give it more money to make new investments. Last month, ARM filed confidentially for a listing in the US. ARM previously said it would list in the US over the UK, dealing a blow to the London Stock Exchange. SoftBank agreed to acquire ARM in 2016. Goto said that he was unable to discuss ARM at length due to the confidential filing in the US, but said preparation for the IPO is going smoothly. ARM posted sales of 381.7 billion yen in the fiscal year, up more than 27% year-on-year. The company's pre-tax income rose 18% year-on-year to 48.6 billion yen. This comes at a time when private equity funds are experiencing their own set of problems. Blackstone said on Wednesday it had blocked investors from cashing out their investments at its $71 billion real estate income trust as the private equity firm continues to grapple with a flurry of redemption requests. Breet said it fulfilled redemption requests of $1.4 billion in February, which represents only 35% of the approximately $3.9 billion in total withdrawal requests for the month, the firm said in a letter to investors. The total Breet redemption requests in February were 26% lower than the approximately $5.3 billion reached in January, the firm said. The stock lost 43% of its value last year. Blackstone has been exercising its right to block investors' withdrawals since November last year after requests hit a preset 5% net asset value of Breet, which is marketed to mostly high net worth individuals. Blackstone expects to continue dealing with investor redemptions because some Breet investors are making larger withdrawal requests in anticipation of a reduction in its size, its president Jonathan Gray told an earnings call last month. Blackstone is weighing options for Dutch merchant bank NIBC, including a possible sale. NIBC did not immediately respond to a request for comment. Valuations for listed European banks have risen since, buoyed by higher interest rates. But a recent crisis of confidence in credit institutions has set back the strategic plans of some mid-sized lenders, including Apollo Global Management-backed OLB in Germany. The Hague-based NIBC offers financing for industries such as automotive, commercial real estate, infrastructure and shipping, as well as retail mortgages. It has been exiting non-core businesses, including deal advisory and leveraged finance, in a bid to streamline its operations. The group had 22.8 billion euros of assets on its balance sheet at the end of last year and an equity value of around 2 billion euros, $2.21 billion, according to its 2022 annual accounts, which showed a profit of 179 million euros excluding non-recurring expenses. Mortgages made up the bulk of its loan book. Blackstone is weighing options for Spanish gambling company Cirsa. Investors in the fund are furious. That is because many of them are now trying to get their money out. Real estate values have fallen across the nation, and macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone is drawing attention from the Securities and Exchange Commission. And, in this case, investors in the fund want to take out more money than Blackstone can make available for withdrawal. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.